In 2025, only 21% of professional fund managers, people paid millions to pick the best stocks, managed to beat a simple index fund over 10 years. Let that sink in. 79% of the smartest, most experienced investors in the world, with teams of analysts and access to information you and I will never have, lost to a fund that just tracks the market automatically. No skill. No strategy. No stress. If that sounds too simple to be true, stay with me, because by the end of this video you'll understand exactly what index funds are, why they beat most investors consistently, and how to use them to build your own wealth starting today. Part 1. What is an index fund? Let's start from the very beginning. An index fund is a type of investment fund designed to match the performance of a specific market index. Think of a market index as a list, a snapshot of a group of companies or investments used to represent how a particular part of the market is performing. The most well-known index in the world is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Alphabet, Google's parent company, and hundreds more. When you invest in an S&P 500 index fund, you are buying a tiny piece of all 500 of those companies at once. You're not betting on one company performing well. You're betting on the overall US economy performing well over the long term, which historically it always has. An index fund doesn't have a manager trying to pick winning stocks. It simply holds whatever is in the index automatically. This is called passive investing, and that simplicity is exactly what makes it so powerful. Part 2. Active versus passive, the real comparison. Now here's where it gets interesting. And this is the part most financial institutions don't want you to know. There are two types of investing funds: active funds and passive funds. Active funds employ professional managers, teams of analysts, economists and traders, who research companies, analyze markets and try to pick the best investments to beat the market. For this service, they charge you a fee. The average expense ratio for an actively managed fund is around 0.59% per year according to Morningstar. Passive funds, index funds, simply track the market automatically. No stock picking, no research teams, no expensive managers. The average expense ratio for an index fund is approximately 0.11% per year. That's over 5 times cheaper. Now here's the brutal truth about active funds. According to Morningstar's latest active-passive barometer, which analyzed 9,248 funds, only 38% of active funds beat the passive counterparts in 2025 after accounting for fees. And over 10 years, that number drops even further. Only 21% of actively managed funds survived and outperformed a simple index fund over the decade ending in 2025. Read that again. 79% of professional fund managers, over a 10-year period, failed to beat an index fund. And those numbers get worse the longer the time horizon. The SPIVA scorecard, the most comprehensive study of active versus passive fund performance, consistently shows that 85 to 90% of actively managed funds underperform their benchmark index over 10 or more years after fees. So why does anyone use active funds? Largely because of marketing, habit, and the belief that paying more means getting more. In investing, that is consistently proven false. Part 3. The fee problem nobody talks about. Let's talk about fees for a moment, because this is where most people get quietly robbed without realizing it. Imagine you invest $10,000 over 30 years and achieve an average 7% annual return before fees. With an index fund charging 0.11% per year, your final amount would be approximately $73,700. With an active fund charging 1% per year, your final amount drops to approximately $57,400. That 0.89% difference in annual fees cost you over $16,000 on the same $10,000 investment. That's not a small number. That's 16% of your final portfolio gone to fees. Over larger amounts and longer time periods, this fee drag becomes one of the most significant destroyers of long-term wealth. And most people signing up for actively managed funds have no idea this is happening to them. Index funds, with their rock-bottom fees, keep the maximum amount of your money working for you. Every decimal point of fees you avoid is money that stays in your portfolio compounding year after year. Part 4. Types of index funds worth knowing. Now let's quickly cover the main types of index funds so you know what you're looking at when you start exploring. Broad market index funds. These track the entire stock market or a very large portion of it. The Vanguard Total Stock Market ETF, ticker VTI, tracks over 3,500 US companies. The widest possible diversification in a single fund. Considered by many financial educators as one of the simplest, most effective long-term investment vehicles available. S&P 500 index funds. These track the 500 largest US companies. The Vanguard S&P 500 ETF, ticker VU, and the iShares Core S&P 500 ETF, ticker IVV, are two of the most popular. The S&P 500 has delivered an average annual return of approximately 10% since its inception, though past performance does not guarantee future results. International index funds. These track companies outside the US, giving you exposure to global economies. The Vanguard FTSE All-World ex-US ETF, ticker VEU, is a well-known example. Adding international exposure reduces your dependence on any single country's economy. Bond index funds. These track bonds rather than stocks, lower risk, lower return. Used to balance a portfolio as you get closer to needing the money. The Vanguard Total Bond Market ETF, ticker BND, is widely used for this purpose. Important disclaimer: the funds mentioned above are examples used purely for educational purposes. This is not a recommendation to buy any specific fund. All investments carry risk, including the possible loss of principal. Always do your own research and consult a qualified financial advisor before making any investment decisions. Part 5. Why index funds work: the simple truth. So why do index funds consistently outperform active management? The answer comes down to three things. First, costs. Every dollar you pay in fees is a dollar that isn't compounding for you. Index funds minimize this drag. Active funds don't. Second, diversification. By holding hundreds or thousands of companies at once, index funds eliminate the risk of any single company destroying your portfolio. One company going bankrupt barely moves a broad index fund. Third, the market is hard to beat. Financial markets are extremely competitive. Millions of professional and institutional investors are constantly analyzing every piece of available information. The idea that any individual manager can consistently find information or opportunities that nobody else has found, over decades, is statistically unlikely. And the data proves it. Warren Buffett, widely considered the greatest investor of all time, has publicly recommended that most people should simply invest in a low-cost S&P 500 index fund rather than trying to pick stocks or paying active managers. His advice to his own family, documented in his 2013 letter to Berkshire Hathaway shareholders, was to put 90% of cash in a very low-cost S&P 500 index fund. That's not an endorsement of any specific fund. That's one of the world's most successful investors telling ordinary people that simplicity beats complexity in investing. Part 6. How to actually start with index funds. So how do you actually invest in an index fund? It's simpler than most people expect. Step 1. Open a brokerage account. Platforms like Fidelity, Charles Schwab, and eToro all offer zero minimums and commission-free trading. This takes about 10 minutes. Step 2. Decide how much to invest monthly. Even $25 or $50 a month is enough to start building a meaningful position over time through fractional shares, meaning you can buy a piece of an expensive fund even if you can't afford a full share. Step 3. Choose a broad market index fund. For most beginners, a total market or S&P 500 index fund is a widely discussed starting point. Research the options available on your chosen platform. Step 4. Set up automatic monthly contributions. Same amount, same day every month. Dollar cost averaging, which we covered in episode 2, combined with a low-cost index fund is one of the most straightforward long-term wealth-building strategies available to ordinary investors. Step 5. Leave it alone. This is the hardest part. Don't check it every day. Don't panic when it drops. Markets go down, sometimes significantly. They have always recovered historically. The investors who lose money in index funds are almost always the ones who panic and sell during downturns. Time plus consistency plus low fees. That's the formula. Index funds are not complicated. They're not exciting. They don't make good stories at dinner parties. But they are, based on decades of data, one of the most effective tools available to ordinary people who want to build long-term wealth without paying experts to underperform the market for them. 79% of professional managers couldn't beat them. You don't need to be smarter than Wall Street. You just need to be consistent. Now we've covered the difference between saving and investing, how to start with little money, and how index funds work. In the final episode of this series, episode 4, I'm going to share the things I wish I'd known before starting to invest. The mistakes, the mindset shifts, and the things that would have saved me years of confusion. Subscribe so you don't miss it. And comment below. Before watching this video, did you know that most professional fund managers underperform index funds? I genuinely want to know. Drop your answer below. This is Funds and Future, the financial education you never got in school. See you in the next one.